In a total shift from the funding boom recorded in 2021 and the early parts of 2022, Nigerian startups have experienced a significant slowdown in funding this year. However, the funding drought is not particular to Nigeria. As of November this year, fundraising declined to nearly pre-COVID levels, with startup founders raising only $3.2 billion in a difficult macroeconomic climate that negatively impacted many global companies and regional scale-ups and startups. This figure is far behind the totals of 2021 and 2022. In 2022, the continent's startups had already raised the same amounts by April before the funding winter started. This decline has undoubtedly impacted the startup ecosystem, prompting entrepreneurs and investors to reassess their strategies and adapt to the changing dynamics. But despite the overall downturn, there have been pockets of resilience and innovation that have emerged. My guest is Efayomi Carr, principal at Flourish Ventures. He leads Africa investments for Flourish Ventures and has worked with founders in the startup ecosystem for the last 5 years. Efayomi, welcome to Business Edge. Thank you so much for joining me.
Thank you for having me. It's great to be here.
So let's start with the decline. We saw what happened in 2023 with the funding decline raise, or the funding raise decline as it is, that took us back to pre-COVID levels. So let's start from there. In terms of the factors responsible for this drop, particularly in Nigeria and across the continent, what do you think those factors are?
Yeah, I think we can look at factors that are both international and domestic, both from a macroeconomic perspective. Internationally, we saw interest rates rise to the highest levels we've seen in almost a decade. So across many asset classes, capital investors were much more interested in reallocating how much of their capital they gave to startups, which are a more risky asset class, relative to how much they gave to more secure asset classes. So even public equities or bonds with high interest rates have a much higher return. So I think on an international level, capital allocators moved cash away from venture capital, private equity, and moved into more secure, high interest assets like treasuries and bonds, et cetera. And then I think domestically in Nigeria, there was lots of macroeconomic turmoil as well. I think the devaluation of the currency, I think as we look at sort of oil prices and scarcity, all these things led to investors being more hesitant to push cash into Nigeria.
So something I noted earlier is the fact that this was, of course, a global phenomenon. It's been a very difficult 1-2 years for many economies across the world. But we saw that with Africa, the decline started a little bit later than we saw it globally, after many more developed countries have started experiencing this as well. So when we sort of compare the similarities and the differences between how this funding winter, as many are calling it, occurred in Nigeria on the continent versus how it occurred globally, what do we take away from that?
Yeah, I think there are different trends that affect Africa a bit differently. For example, when you look at how capital cash dried up internationally, oftentimes, at least for later stage deals, it hits Africa a bit separately. Many of the capital allocators will only invest in Africa at the later stage. Those will come from international investors just because the large pools of capital from private equity funds and venture capital funds will be international. However, if you look at the early stages, a lot of that cash comes from Africa. It comes from domestic investors, angel investors, and early stage funds. Many of these funds were insulated from some of the challenges globally. So at the early stages, African startups and African companies were still able to receive funding. It was only at the later stages when cash was coming from international investors where there was a real dry up of cash.
So you talk about this being sort of a trend that we've seen. So another trend we noticed in 2023 is that African startups also pushed deeper into the debt markets. And this is said to have accounted for about 1.1 billion, around 35% of the amount of money that's been raised as of November 30th. When we look at the debt funding, in 2021, it was around $257 million. In 2022, it was $676 million. Now we've crossed the $1 billion mark. What's making debt funding so attractive to startups, particularly here in Nigeria? And is this a win for the industry? And is also a trajectory that you think will continue to see move upwardly in 2024?
Yeah, I think there's probably two things that are pushing this. One is just availability of capital. So as I mentioned earlier, equity investments, particularly for those coming from international investors, has dried up. And so startups are seeking other alternative ways to access capital in order to continue to stay alive and to scale. And so they've shifted from equity to debt simply because there's been more availability relative to equity. I think the second is just a reorientation of the fundamentals of tech startups. Whereas a year ago, 2 years ago, because cash was so available, all the emphasis was on growth, was on how do you scale, which really required equity investment to finance unprofitable businesses. Now the shift is towards profitability, is towards high margins, it's towards sustainability. And in these models, debt becomes a much more valid form of fundraising relative to equity. And I think as we think going forward, these trends will continue. Unfortunately, interest rates have remained high globally. And so investors have still been reluctant to shift capital towards venture capital. I think in the next couple of years, this will return, but in the short term, particularly for Africa, this will remain the case. And so I think companies will continue to see debt as a strong alternative to equity financing. And I think it's actually a good thing. It means that we are reorienting the fundamentals to build more sustainable businesses in the long term.
Okay, so let's stay on the attractiveness of debt funding, because there are those who are a bit worried about it posing some kind of significant threat to African startups. So I want to get an idea of where you stand on that. Yes, it's meeting a need right now, but as you said, it's probably just going to last for a few years before we see a return to venture capital. But beyond that, do you think there are any concerns, any genuine and sincere concerns when it comes to debt funding for African startups and that being a vehicle for them to get to where they want to go? What are the risks?
Yeah, I think the risks are mainly towards the capital allocators. So when you think about an equity investment, we do equity investments. We take on a certain amount of risk because we understand that a certain number of companies will fail. For a debt portfolio, that looks very different. Debt funders are not able to take the same amount of risk. And so if a company fails, that has a much more significant impact on the funder. And so I think when we see what are the long-term risks of increased debt funding to startups, really it means, will there be capital in the long term? If people get burned, if companies do fail, which is a huge likelihood for early stage startups, then the debt funders will be more reluctant, and then that will dry up another source of capital. So I think that's the real risk is, are these funders going to be able to accept the same amount of risk as an equity funder would? And the likelihood is no.
All right, Efayomi, let's look at how this year played out. And it can be in very difficult situations that some people actually find their boom. And so looking at the startup sectors, markets, investors, and even the ecosystem as a whole, did we see any breakout sector, any surprises? Did we see anybody who was able to leverage this economically challenging time and make the most of it?
Yeah, I'll take two perspectives, one international and one domestic. I think internationally, the big thing on everyone's mind has been AI. We've seen so many companies, we've seen such a huge rush of capital going to AI, not just generative AI and large language models, but a variety of AI-enabled companies that's affecting everything from healthcare to insurance to finance. So internationally, we've seen a huge boom in AI. We haven't seen that yet on the continent, but we have seen one sector that's done incredibly well and really has paved the way for future success, and that's been in climate. So as you think about, we've had the COP just happened a week or two ago, and there was huge commitments to financing climate. I think that's on the continent is where there is some of the biggest success stories and some of the largest opportunities. And so I think within the climate space, we've seen lots of funds being raised. So, GPs are raising capital, but also lots of startups and just in general companies accessing financing. And this has come across renewables, across ag, and across mobility. So that's the sector that this year saw a huge spike in fundraising. And I think it's only going to continue as more capital goes into the space.
All right, so a bit more of a look back into 2023 in terms of being a venture capitalist, being in this space where we've seen this development of Africa's startup ecosystem, fintechs, agri-tech, edutech, whatever you want to call it in the past few years, and the amazing work that they're doing. What do you think have been the biggest lessons you're taking away from 2023 before we move on to some of the projections for the new year?
Yeah, I think the biggest lesson is sustainability. I think so many startups in the last couple of years have only been able to survive because they know that the next check is coming. They've relied on future fundraising as part of their fundamental business model. And I think when we look at winter of investment winter like we are in today, it just reinforces the riskiness of that type of strategy, because we don't know what kind of macro events will catapult funding, and we don't know, necessarily when the next check is coming. And so the big takeaway has been companies need to have some form of sustainability with their core business models that does not rely on a glut of cash in the future in order to survive.
That's interesting. And I want to take a look at the fact that in just the past few months, we've heard about a number of fintechs or even just startups in Nigeria that have closed their doors or modified their businesses because of the challenging times that they're facing. What lessons do we take from those decisions, the ones who've decided to either shut things down or even modify the business to adapt to the situations that the economy is facing?
Yeah, no, we've seen so many companies who shut down, and even within our portfolio, we've seen companies who have struggled. I think the reality is for many of these companies that it is the wise thing to do and also the responsible thing to do to shut down. Shutting down doesn't necessarily mean you failed. In some instances, it means you've realized that there's an alternative way to be successful. And so you return cash to your investors and you start over fresh, which actually might be better for your business in the long term. So I think for many of these companies that shut down, I think we have to understand what drove them to shut down. Sometimes it's they had a fundamental flaw in their business model, in which case it's a wise thing to shut down and start over. Sometimes they couldn't raise additional capital because the capital pools have dried up. And then sometimes it's actually due to sort of regulation. They weren't able to achieve the licenses they needed, or they're operating outside of regulatory boundaries, which meant that they weren't sustainable. And so I think it's important to see why these companies shut down and understand that sometimes it's a wise decision, that there are still opportunities, but with an existing business model and an existing capital structure, it might not be amenable to actually reaching those goals.
Mm. So still coming into a bit of 2023 to project into 2024, we saw a lot of challenges for many African economies this year: currency depreciation, forex illiquidity, and so many other things. Of course, you mentioned earlier rising interest rates internationally, making it difficult for them on the local side, on the domestic side. So what do we think about those macroeconomic sort of detrimentals at the end of the day, and how that will play into what we see in 2024? How much of an impact do you think we're going to see, a continued impact we're going to see from what we've experienced in 2023 into 2024 when it comes to those issues?
Yeah, you mentioned the sort of challenges we faced from macroeconomic issues. And then I actually do want to be specific here, because I think in each market it looks slightly different. We've talked about Nigeria, how currency devaluation, how forex scarcity, how these things have actually driven a lot of challenges in the short term. But we hope that they actually create medium and long-term opportunities. They actually mean a more sustainable path to growth. You can say a similar story about Egypt, which has also has challenges with their currency and with access to foreign currency as well. I think Kenya is a bit of a different story. In Kenya, they're coming to a big bond repayment in the next 6 months, which will have a big impact on the currency. So Kenya might just be entering a phase where they're going to be more destabilized by macroeconomic trends. Whereas in Nigeria and Egypt, they might be sort of seeing a way out, light at the end of the tunnel relatively soon. I think what's important to note is that all of these macro challenges also provide opportunities. If we talk about forex, lack of forex, one of the biggest innovations of the last 2 to 3 years has been the advent of stablecoins. So of users being able to not just access US dollars through hard currency, which is often regulated by central banks, but also being able to access USDT and USDC. So stablecoins and with billions of tens of billions of dollars in liquidity mean that I can actually have, despite an unstable currency, I can secure my own assets in US dollars, and I can actually conduct cross-border trade or transfer money to my friends or pay for goods without needing to have hard currency as well. And so a lot of these challenges we've seen in 2023 were unique to each market, and we're starting to see some green lights some lights at the end of these tunnels. But we're also seeing innovations that have spurred because of this, and I think that's really exciting.
Okay, so exciting times ahead. So let's look into this crystal ball and see what 2024 may hold. What are the top 3 things you think we need to expect, or the trends that might end up driving the industry in 2024? And it can be difficult because one thing can happen in Q1 and change the complete trajectory of the year for us. But looking at what we know now from 2023, the experiences we've had, the modifications in business, the shutdowns, whatever it may be, what do you think is going to carry us into the first quarter and the second quarter of 2024 in terms of the top trends?
Yeah, and I think in the short term, the lack of funding we've seen in 2023, we're starting to see that recover. But what that means in the short term is there will be a lot of companies that are actually low on cash or unable to fundraise. So I think the first trend will be an increase in M&A activity. We've already seen a growth of mergers and acquisitions last year, but I know now we're seeing it every day that there are companies who are either low on cash or having difficulty fundraising, that if they do a merger or if they do an acquisition, it actually puts them in a much better capital position, but also means the fundamentals of their business improve so they can be sort of more sustainable in the long term. So M&A will continue to increase, particularly as funding is lower in the short term. I think we'll start to see a recovery of funding. And I don't want to say broadly, but I think, as I mentioned, in sectors like climate, in sectors like AI, and in sectors like fintech, we'll start to see capital return. And that's going to be really encouraging for a lot of these markets, because again, there are in these times is often when you have the best returns for a venture or a startup portfolio. And so I think we'll start to see capital return into specific sectors. And then I think 3, we'll start to see more intercontinental activity. And so I know we've talked about sort of, the Africa Free Trade Agreement is coming online. In Kenya, for example, they're opening borders physically so that individuals can actually enter. And so as we think about the 3 main goods or main things that can go across border between human capital, financing, and then goods, I think all 3 of those are going to start to open up as the continent starts to pull together. So those are the 3 trends I'm actually really excited about. A growth in M&A to drive more sustainable, healthy companies, a rebounding in funding in certain sectors, and then this growth of intercontinental trade and movement of people and capital.
So it does seem to me like you really did look into a crystal ball, because my next question did also have to do with mergers and acquisitions. So I'll ask the other parts of it. In terms of company funding stages, what do we expect to get hotter or cooler? Sort of playing that game many of us may have played as when we were younger. And in terms of even IPOs, what are we expecting? You've answered about mergers and acquisitions. Do you see the same thing happening with IPOs, with the funding stages, hotter, colder? What are we looking at?
Yeah, it's a really good question. I mean, I think frankly, IPOs and local African exchanges are very challenging. I think we still don't have the amount of liquidity that we would hope. I think we still don't have a great infrastructure to support companies that are developing IPOs, and so it becomes hard for a business to manage. With that being said, as these companies mature, I mean, we're seeing companies in our portfolio like Flutterwave, for example, who have the fundamentals in order to IPO. They have strong teams, growing revenue, strong unit economics, and sort of really good fundamentals to go to an IPO. What a lot of these companies will start doing is looking internationally. I think traditionally we've always seen sort of New York, either the NASDAQ as the sort of go-to market. I think secondarily we've seen sort of London and Hong Kong as attractive markets depending on your investor structure. I think what we'll start to see is an emergence of a third option, which is the Middle East. I think the Saudi market does have those things. It has liquidity, it has a strong market, and it has dynamics that are actually quite similar to what we're seeing in some of our African markets. And so I think going forward, IPOs will still be a bit challenging, but we'll actually have more alternatives for companies looking to IPO beyond the local markets.
And that does really make it sound exciting and interesting. Efayomi, before I let you go, we know that fintech continues to basically dominate the ecosystem for many of us across the continent, across the 4 countries, the 4 cities in particular that seem to be the places where these conversations are dominated. But you've mentioned climate funding as the kind of funding that we're seeing coming up as well. What else do you think in terms of the subsectors or the sectors of this ecosystem that we're going to expect to see some serious movement from and some serious growth? What are we anticipating? Where and who and which sector do you think is really going to come out the shining star in 2024?
Yeah, so I'm a fintech investor, and so I'm always going to be bullish on fintech. And I think because it has all these I can apply to so many other subsectors between healthcare, insurance, et cetera. I think fintech will actually be very resilient going forward. I mentioned climate. I think climate will probably be the sector that sees the single largest increase in capital funding over the course of the next 2 to 3 years, just because of how much money from international investors is being directed to the space. And I think the third is going to be AI. I mentioned AI, but again, we've seen AI, AI companies in the US that have, or in the US, Europe, and internationally that have received so much funding. I think it's only a matter of time before some of those innovations move to the African continent. And fundamentally, in order for these large data models to be accurate, they need localized inputs. So we'll need companies in Africa to develop local solutions in order to have the same type of innovation we're seeing abroad. So I think that's a space where we're ripe for innovation, where there's lots of capital availability, and it's just a matter of time. So those are probably the three spaces where I would put my money going into 2024 and beyond.
All right, I'll hold you to that, and we'll probably check back around in the next few months to see how the sector and the ecosystem are developing. It's been an interesting and challenging year, but we've seen the resolution and the resilience in the past 2 or 3 years, and those numbers have just continued to be record numbers. Yes, a decline this year, but we're hoping that the fallout and coming out of it into 2024, we can rebound and, of course, again, break some records. Efayomi Carr, principal at Flourish Ventures, thank you so much for joining me on Business Edge.
Thank you for having me. It was a pleasure.
Fantastic.